Hello, hello. How are you? Welcome to this new episode number 14 of Chasing the Deal. This time we are going to talk about an exciting market. You may say it's a small market, but I really like this city because I'm a fan of the Chiefs uh, of the football team. But also, this is an exciting market because not just good deals are not only on big markets. So this is a Midwest market, and we may find some good deals here. If you one of the some of the best deals I've ever found are on the mid cities or the small cities, maybe. But this time we are going to talk about Kansas City, Missouri. So let's get ready to get inside this topic. Let me show you, for those of you who is the first time you see this channel, see my lives. This is my preferred property intelligence software. It is called CoStar. With this software, I analyze all the properties, uh, all commercial properties all over the U.S. But as you may see here in this screen, we can also analyze some properties in Canada, even. Okay, you see here an industrial properties or markets. These are markets in Canada, like for example Edmonton or Calgary, which are I think are the one of the biggest markets in Canada. But you also can see here in the UK some markets, like some here in Scotland. I think this part it's close to Edinburgh, and many parts of the UK. You can analyze those markets. Okay, so even the Channel Islands. Okay, so you have plenty of information here in CoStar. So this is the software I will use to show you the information on this market, which is Kansas City. Okay, so let's deep dive into Kansas City. So let's uh, let's find out more information about the market. Let me show you. Let me show you. Mhm. Okay. Let me show you this information on the market. So I'm going to expand some the screen. So here we have Kansas City. And here you can see some of the KPIs of this market, key performance indicators. Okay. So for example, let me show you a little bit. I want you to see all the KPIs. I don't know why this is some kind of lagging today. Okay, I think I may show too big on YouTube. I don't know how to fix that. I hope you can also watch me on LinkedIn for you watching me on YouTube. So I'm broadcasting in YouTube, Facebook, and LinkedIn as well. So I don't know, maybe I'm showing so big in YouTube, but I don't know how to fix it. Uh, okay, so let me show you first. I'm going to explain these KPIs. So first of all, here in CoStar software, you can see at the top of the screen these numbers, like for example, the inventory. Okay, so the inventory, what does it mean? It means the total uh, size of the market. So for Kansas City, we have 381 million square feet total on the market. So it went up actually from the last year, 3.4% up okay, from 368 million to 381 million. So it went up 12 million extra square feet that probably were delivered by the developers. Okay. Then we have this number that is under construction. So we can see also here some trends. We cannot only see the number right away, but we can also see the trend. So you can see here the current under construction square feet. It's 6 million square feet, but year ago it was double. It was more than double actually. It was 13.4 million. So that means from the last year up to the excuse me, from 2024 up to 2025, it went down 53%. So it means the market may be cooling, or the developers are not building a lot of space, but because maybe they deliver a lot of space from the past years. So they are cooling down the things and they are starting to build less than that. Okay, so that's what we can see here. Maybe an over delivery market. Okay, so we can see also the net absorption here. Okay, what's the net absorption? The net absorption is the new space being leased. Okay, so it doesn't count if you have a tenant and this tenant moves on the same market. So it leaves one property and then rent another. Okay, it doesn't count into the absorption. It has to be with new tenants moving in. Okay, so we have a net absorption here of 6 billion. Okay, so last year we had 9 million. So we can start to figure out why this number went down under construction, because net absorption also went down. So because not many tenants were absorbing or renting out that new space, then developers stop building that much space. Okay, so then we have the vacancy rate. So the vacancy rate has to do with the total inventory. What size of this inventory we have now listed out. Okay, so or vacant, excuse me, we have vacant. So that means 6% of this total inventory it's vacant right now. But it also shows that it went up from last year from 4.7% to 6.1%. So that means maybe again an over delivery problem. Okay, that may mean that the market actually is cooling down. Okay, but we also see here a number on the market asking rent. So we can see even when the vacancy went up, we can see the rents went up also. So that means that may sound like counterintuitive. Okay, because if we have a vacancy going up, why we have rent going up too? Okay, so this is a good indicator, but most of the U.S. markets are going up right now. Okay, even if the vacancy went up, the rents also went up because of the inflation, actually. Okay, because for example, in manufacturing, these companies are exporting more, let's say, or their sales are growing, because now if let's say an orange, they sell orange, but last year orange were $1 and now the orange are $2. It's just a number I throw. They are selling more because of the inflation. So because they are selling more, they can pay more for the rent. Okay, so that means we can increase the rent because of the inflation, because these companies are having more sales. Okay, even if the market is going down. So that's why it sounds counterintuitive, but if you view from the inflation standpoint, you can figure out why it will work. Okay, so last we have the market cap rate. Okay, so the cap rate is basically how much are you getting from your hard-earned monies from your investment, how much are you making. So a small cap rate, that means you are not getting as much as a higher cap rate. Okay, but the higher cap rate also means more risk in this market, and also may mean the market is less liquid. That may mean, okay, so that also means more risk on this market. Okay, so basically, if you see these 7 KPIs, you can figure out many of the of what's going on in this market. Okay, but let's read all the report, because we have some interesting things here, so we can develop a strategy to invest in this market, because all markets are not creating equal. Okay, so some markets you may say, I will have here a core strategy or a core plus strategy, so I will just buy, and I will maybe take some leverage and then sell after 5 years and do nothing, just keep it on autopilot. But in some markets you may have more risky strategy, like a value add or a ground up strategy. Okay, so you buy something, you renovate or you make some changes in the property, and then you list it up, and then sell it after, let's say, you can sell it maybe after 2 years, or you can sell it after 5 years, but it's a more risky strategy. But the thing is, not all markets are created equal. You have to first analyze the market and then decide what strategy are going to follow. Okay, so that's what we are going to do here. Okay, so we see, for example, here a summary of on this market. We can see over the past 12 months, let us see. Okay, despite storm, okay, construction is moderate. Okay, so let's see some comparison trends between this market and the national markets. So we can see some benchmarks here. For example, the market asking rent here, you can see it's a little bit lower than actually much lower, like almost half of the national average. Okay, so usually in mid to small markets, you can see smaller rents. Okay, and that's not only because tenants are willing to pay less, but maybe you have older infrastructure. Okay, so if you have older buildings, those tenants will not pay as much as a newer building, as a class E building. Okay, so that's why we see on the national more rent, tenants paying more rent, and here we are paying tenants are paying like $7 per square feet. So the vacancy 6%, national 7.5%. Okay, availability, it's kind of the same thing as vacancy, but availability also includes space that, for example, you have some tenant in a property and this tenant is moving out in 3 months, that space will be available because the tenant will not renew the lease, So So that actually it's not vacant because the tenant is still there, but it's available because he will not renew the lease. Okay, so that's why availability is always a little bit higher than vacancy. And also you can have some spaces that you have already a tenant, like a big space, let's say a logistics industrial real estate property, and you have this, let's say 200K square feet space, and but this company maybe they don't need all the space, they just need 100K, so they will lease up a half of the building. Okay, if the landlord agree to sublease to this tenant to sublease, they can actually sublease this half of the building, and they will. That half of the building. It's counted into the available space. Okay, it's not vacant, but it's available because it's the tenant is looking to rent it out. Okay. So let's say monsoon market, for example, this monsoon market KPI. It's how much are you, if you sell the property, how long are you keeping the property while it sells? Okay, actually, uh, as you can see, national it's 7.2 months, because actually less than 6 months is very rare, you know. So so 7 months it's a good number. So that means probably you have many investors looking in that market. Demand absorption, I told you about the absorption, new tenants moving in. Okay. Leases the square feet. Okay, you can see how much space got leased last year. So this is probably this counts the space that if you have one tenant in one property moves out and then moves in the same market, you are here counting this space. That is different from the vacancy because you are counting this space. Okay, even if it's in the same market. Leasing probability 40%. Okay, to lease the space in less than 6 months. Okay, so in national it's 46%. So you can see here, you can start realizing, figure out that this market is a little bit slower than the main markets, you know, because the probability to lease it in 6 months is less than the national. Okay, so that means the market is kind of little more slower than other markets probably. Okay, inventory, you can see how many buildings were built last year. 23 new buildings. Okay, that was a change, and you can see actually the number of those buildings on the market, the inventory, average building square feet. You can see here it's 50K, which is in line with the national average. Under construction. Okay, delivered transactions. You can see the transactions going up actually 24%. So that may mean new investors are looking for something in this market. Some markets like this may be boring, may seem boring, but reading these numbers, you then discover you then connect some dots, and then you realize you can do some kind of strategy. So that's what we are looking to figure out in this market. Okay, cap rate, you can see the cap rate going down, the compressing. So that means something is going on, because when a market compresses, that means it becomes more, you are having more demand maybe in this market. That's why it's compressing. But even the cap rate, it's higher than the national, you see. Then you see these graphs here on the vacancy. You can see the vacancy, it's an all-time high right now. Okay, and 12-month net absorption. Okay, it's low. The higher, the better. Okay, you see delivery square feet. You see all-time high. Maybe we have an over delivery problem here. Okay, so market asking rent growing 2.1%. Okay, sale price asking rent per square feet all-time high. Market asking rent, sale price 68. You can figure out maybe all builders are selling here, because 68 it's a price for an old building. It's not for sure for new buildings. Okay, in the cap rate you see all-time high also here. Okay, leasing, you can see here at leasing that, and that's why that's where we are finding something here. We're starting to find something. We can see, I will not read all these things because you will get bored, but what it says here, it's most of the new projects, at least new projects here, are built to suit. Okay, so spec projects, what is a spec project? A spec project is a building you build, but you don't have the tenant before you put the first brick on the site. So you are building, you are investing, you are taking a loan, and then you are trying to find the tenant. Okay, you may find the tenant while you are building the project, while you are into the construction, but it's still speculative. Spec, that's why they call spec. Okay, so build to suit projects, it's different from spec because you first have the tenant. Okay, you first have the tenant, and then the tenant asks you to build something specific to their needs. Okay, so that may be, for example, Amazon. I know Amazon use a lot the build to suit business model. Okay, or construction model or development model. They use build to suit because they have very specific needs. If they were going to try to find some space for their Amazon Web Services or the distribution centers, they probably will not find something. Okay, because they have very specific needs for their supply chain, for the ceilings, for the robots they have, so they will not find the space. So they have their own team, and they are with that own team, they work with the developer, because in the build to suit, even if they build the space suit for the needs, the site or the land belongs to the developer. It doesn't. It's not owned by Amazon. It's owned by the developer. So what the developer does, it's he goes find the land, purchases the land, and then market the land as a build to suit project. Or maybe he calls the companies he already knows, or his realtor or his real estate agent knows that work with build to suit. So he calls these companies, and they offer this site. And basically what these companies analyze, it's the location. Okay, the location, maybe the size of the property, of the plot of land. And then once they agree with the location and the size of the plot of land, then they accept and they start developing a new site, a new project. Okay, so it's no risk for the developer, because usually you know, purchasing land, it's most of the time no risk, you know, because it's like having money on the bank. It's just land instead of money. Okay. So what the developers, if he has the money, he pays cash for the land. Okay. If he has not the money, he may enter into a contract, into a purchase and sell agreement. And these purchase and sell agreements, it's not the same as the purchase and sell agreement for purchasing a house. Usually the option period here, it's more than 6 months, okay? Because they have to make some studies like topographic studies, geological, geotechnical, you know. So they usually enter into a purchase or sell agreement, or maybe an option contract, which is kind of the same thing. And that's kind of seller financing, because the seller cannot sell that property, and he's acting as a bank actually. So in the meanwhile, what the developer does is he goes to find the tenant. Okay, he goes to find the tenant, and once he finds the tenant, then he starts developing the project and everything. He got the plans done, and then he goes with the lender. Okay, and he goes with the lender, and he secures the lending. Okay, so when he secures the lending, he goes and close the deal with the seller of the land. Okay, so that may take maybe 6 months, maybe 1 year, maybe up to 2 years. Okay, but it's not kind of risky for the developer, because he's not investing any money, you know. He's not investing. Even if it's a purchase and sell agreement, he can step out anytime from the deal. He may lose the deposit, but it's kind of nothing for them, you know. It's very small part. So what says here, it's most of these tenants are built to suit, and spec projects are cooling down. Okay, so we start finding a trend here. Okay, we start finding the appetite for land. Okay, we may buy some land or enter into a contract with land. And another thing, there are two kinds of build to suit, two types. Okay, the first type, it's okay, you as the developer go purchase the land or enter into a contract, and then you invest on the soft cost, on the plans, on the architect, the engineering, the studies, everything. So you have to, before you secure the loan, the financing, you have to have some money for the soft cost. Okay, so basically this money, maybe you have it as a developer as cash, or maybe you go find some investors. Okay, this is the build to suit, the normal build to suit. But there's another kind of build to suit, which is the reversal build to suit. In this way, you go, same thing, you go find the land, enter into a contract, or maybe purchase the land. Okay, and then you go find the tenant. But the difference is this tenant has his own design theme. Okay, so he will pay for the design. You will lose a little bit of control on the design, but the thing is he will pay for it. You don't have to find investors to pay for the architect, the engineering, the studies, because this team already has the in-house team, you know. So that's what we are going to do here, because we don't need money here, you know. We don't need big money. We can do here in Kansas, because it's a small or mid-sized market. It's a slow market. So we can go with the seller. We can go with the seller, find some land, and ask for a purchase and sell agreement, and hold it like 6 months to 1 year, and we just put like 10,000 down, okay, as an earnest deposit. Okay, so if we don't close the deal, we will lose 10,000. Okay, that's it. But if we find that this big company, we make millions. Okay, so also we don't need the money for the soft cost, because the tenant will pay for it. Okay, so that's the strategy we will develop here. Okay, most of these, that's the basic thing that here, that the build to suit projects are. Another thing, we can see data centers here in Kansas. Why? Because Kansas is located on the center of the U.S. It's in the Midwest, of the U.S. And usually with this AI trend, they are building a lot of data centers all over the U.S., but they need it specifically located close to major markets. So Kansas City is close to Dallas, okay, and close to other markets like Minneapolis, for example. So many companies are building data centers because the land is cheap and the energy is not that expensive. Okay, it's close to Texas, so we are looking for some, and happens to be that these kind of companies that build the data centers, they use this build to suit, the reversal build to suit model. Okay, so that's what we are going to do, because otherwise, if we bet for the companies that are already there, here it says on the report that these companies are not going, are not in the best moment. Their best moments are usually manufacturing companies, okay? But they are not in the best moments, okay? We are also not betting for the internal market because it's a small one, it's a small one. Usually people, they don't make much money. So what we can do, I think the smartest thing to do in a market like this, with cheap land, good location in the middle of US, and a rising trend in the AI data centers, the best opportunity here is build to suit. Okay, maybe build to suit, but if you don't have the money to pay for the soft cost, you can do reversal build to suit. Actually, in these companies, these AI companies will pay for the soft cost. Okay, so we can see other KPIs here. Population change, that doesn't matter too much for this strategy. Okay, we don't need too much populations for data centers, are mostly automated. Okay, so population is not growing too much. Originations, outstanding low balances, income and expenses, we see a decrease in the effective gross income from the last year. Okay, capital, let's see top buyers, Stack Industrial, capital. These are more private equity firms, big funds. Okay, these are the developers that are making this kind of projects, the build to suit. Okay, we can see the sell by buyer type. We can see private as the most active buyers here, and also as the most active sellers. So, okay, so now we choose a strategy here, and we are trying to let me see. Okay, we are trying to find the property now. Okay, we are going to find Kansas City. We have this tab here. Also, the markets you can see here and the properties. You can find the properties here, or you can find the properties here in the sales tab. Okay, but I also prefer, I pretty much prefer to click the properties tab, because here I can see all the properties, even the properties that are off market. Okay, at least the properties that this CoStar has in the system. Okay, so let's see. First, I'm gonna show you something. I want to show you something. We are going to purchase to find the land, but first we have to figure out which one is the path of growth. Okay, where are we going to find to purchase the land? So for that, we will see first the industrial properties, all properties that are just built, okay? So, or under construction. We filter up these properties, let's see, also by size, at least 50K, okay? 50K. And then we see industrial, let's see, built, let's say from 2023, 3 years ago, okay? Where are those properties? So we filter up this thing, and we find here, we find that most of those properties are here on the south, on the 35 corridor, okay? Some of them are to the north, okay, and as well on the 35, okay? So we have two spots here to decide. First one is the south, and the second one is the north. Let's see which city connects to the north. So to the north we have Des Moines, Iowa, okay, and also we have Minneapolis, okay. Maybe Des Moines it's too small, but Minneapolis is a major market, okay. But now let's see to the south, which city connects to the south. So we see Oklahoma City and we see Dallas here, okay. So if we are betting for an AI data centers, I say this is more important, the South Corridor, because Dallas Fort Worth has more people than Minneapolis, okay. So let's bet for this part of the market, okay, for the South. So we already see where are the new buildings, industrial buildings. So now we are looking for land, okay? Now we filter some land, okay? You see plenty of land, but we only are looking for land for sale this time, okay? So land, let's say at least for an AI data center, we need, I would say 5 acres, okay? So let's find first the biggest, and then let's see the land. Secondary, we needed industrial. We can find agricultural land and then make a zoning change here, but we are just lazy. We just want to ride the wave, okay? So we need to be ready. So we are not looking to rezone. We are looking to just purchase or enter into a contract and then offer that that piece of land to the build-to-suit developers, build-to-suit tenants, okay? So here's what we have. We have plenty of space, as you can see. Let me now, as we have many space, let me now filter up to, let's say, 10 acres. Okay, because we don't want big pieces and one big kind of investments. So we end up with these places. Okay, we have 3 that are close to the 35. So let's see how much are they asking. You see, this one, it's almost 6 acres, and they are asking 1.3 million. Okay, let's see a little bit more about this. How long is it on the market? I always see that number, how long they are sitting on the market. I can see right here. Okay, but usually land sits for a while. Okay, so this one, they are asking 1.3 million, and this is industrial land, because we already filter up for industrial. Okay, here we can see, for example, the zoning. It's M2. I don't know what is M2 into Kansas City zoning, but must be manufacturing, light manufacturing, something like that. Okay, we also have this one, 8 acres, a little bit more, 1.5 million. Okay, they are asking 1.5 million, but this is not right in the corridor of the 35. It's in the 169. Okay, it's close to that. You know, I would say it's not a big deal, because you have this street here that you can go to the 35, but it's not as close as this one. Okay, and this is asking 1.3 million. This is asking 1.5 million, and this last one, it's 1.6 million. It's exactly 5 acres. Okay, so we have these 3 options. So I'm gonna give you 1 minute to vote for the winner, and which one you want me to analyze, or to deep dive into which piece of land you would like me to analyze. So the first one, it's 6 acres, asking 1.3 million, 1.35 million. That's the first one. 6 acres, let's say 6 acres. Then we have the second one, 8 acres, asking 1.5 million, a little bit more, for more than 50% more of land. Okay, all zoning PEC3. I don't know what is that, but it doesn't sound like manufacturing, but I already filter up for industrial. Okay, and it says proposed use commercial and industrial. Okay, so, and lastly, we have this one that it's let me see if it has the zoning, commercial, retail, and self-storage. Okay, this one, it's commercial. Okay, I don't see here for industrial zoning, but industrial land it says, but it's 5 acres, 1.6 million. So which one? I'm gonna give you 1 minute to vote. Option 1, 1.3 million for 6 acres. Option 2, 1.5 million for 8 acres. And option 3, 1.6 million for 5 acres. Which one you want me to analyze? So let's start the voting. I'm gonna give you 1 minute, and then I'm going to deep dive into the choosing, into the winner. Okay, so if you are watching me on YouTube, you can comment. If you are watching me on LinkedIn, also leave your comment, and also in Facebook if you are watching me. Okay, So first option, um, 6 acres for 1.3 million. This is manufacturing. Um, Option 2, 1.5 million for 8 acres. And option 3, 1.6 million for 5 acres. Okay. So which one? I like three. I like most this one. The first one. It looks like it's already for industrial, and I can see it's inside the city limits. And this one, I don't think it's into the city limits, so probably has no utilities. It say it has offsite improvements, electricity and water, but I don't see the sewer. This one, probably it has already the sewer. And this one, I think it's more like retail, but I don't know. Okay, so okay, so I think we have a winner now. So let's analyze, or let's find out if 1.3 million for this piece of land, it's a good deal. Okay. Okay, we have this 229,000 per acre. Hmm. Let me see the flyer. I will see the flyer. Let me show you here the flyer. I want you to see. Replace. Okay. Okay, this is the flyer. For sale, 6 acres. Zoning M2, General Industrial District. Okay, population. Not plenty of information here, but I see it's close to Garmin, which may be good thing because Garmin is a Tier 1 company. Okay, so how much would you pay for this one? Okay, to find out that information, let me show you again. Replace. Let's find some comps. Okay, let's find some comps. Let's find some comps. Okay, so let me find some properties back. Set comps, Kansas City. Industrial. More. Let's say more than 100. Okay. So let's find some comps here. How much did they sold for? Okay. For example, we have this one. Uh, 223, 83 months. I'm trying to find the price per square feet here. Okay, 359. Okay, and then let's find the FAR. Mhm. Okay, so we have 360 per square feet here. $360. I don't see the FAR property. Point three. Okay. Point three. $360 and FAR 0.3. Okay. So let's go back to the property. Okay, so this was the property. Okay. So if we build something here, we may have the same FAR, which is 0.3. So actually, let's say, let's see. $200. So what we will do is we will multiply the total area of the land. It's kind of a comp, but in commercial, it's not very exact, the comps. But I want to show you this way. It's the fastest way. So we have 266,000 and 133. Okay. Let me see. Okay. Let me see. 260. The total area by 0.3. Okay. And then we have the area, the constructible area, and then we multiply by 360. So if we build something here, we should have 27 million. Okay, 27 million for a class A property here. Okay, if we build something in this piece of land, so we would got 27 million. So usually the part of the land for that 27 million we will sell the property for should be around 20%. So if we multiply this by 0.2, it goes to 5 million, 5.5 million. They're asking 1.35 million. Okay, so I think we are good with this. Again, this is not like the best way to get the value of a piece of land. The best way is to actually analyze all the cash flows, okay, all the cash flows, and then get the present value of that building, and then from the cost of the building, then we subtract or cost of the construction, and then we subtract also with the profit. Okay, and then we go with some IRR or internal rate of return. If we want for that development maybe 20% IRR or 25% internal rate of return, then we should get the right asking price for the land. Okay, so that goes with the we should get first the total construction area, the total cost of everything, and then we play with the IRR. Okay, because that's the number we are going to offer to our investors, and all the subtracting all those numbers, we should end up with the price of the land. But for this fast way to calculate this, which is first we should find the FAR, which is the floor area ratio, which is what part of that lot it's buildable. We can build something there. Okay, so that's 30% of that lot. So we multiply the total area of this lot by 30%, and we have the buildable area. So with that area, we multiply with the comps. With the comps, we see it's 360, and then we got the total number for a complete property, class A property. And then usually from that number, 20% is the cost of the land. So in this example, it was 5.5 million. So if they are asking for 1.35 million, I think that will be a good deal, especially if you manage to sign a purchase and sell agreement with this seller, and he can hold the deal for at least 1 year, because in that 1 year you will go find the tenant, and then the tenant, if you choose to go with the reversal build to suit model, then the tenant will pay for the soft cost. Okay, so this is basically the strategy I will choose for Kansas. I will think build to suit is a good way to go, and especially build to suit, reversal build to suit with these AI companies or data centers. So what do you think about this strategy? What do you think? Maybe you would choose another strategy, maybe core plus, maybe flex spaces. I don't know. So what do you think? Leave your opinion on the comments. And well, thank you for watching. If you like it, give me a like. You can subscribe also to my channels in YouTube, in Facebook, in LinkedIn. I'm as the Nearshoring team. You can find me there. And also, if you want to invest in commercial real estate, I can help you to find the right property, either it's land, either it's industrial manufacturing or industrial warehouses. Um, so just contact me. I will leave my contact form on the description, and I will find you. I will have you find you a property. I'm a real estate agent licensed here in Texas, and I work with DXP Commercial, which is the firm with the most number of with the largest number of real estate agents in the world. We have agents all. I think it was last time it was like 22 countries all over the world. We're in Europe, in Mexico, in Canada, in the US. So I can help you find property anywhere with this, with the help of this network, and also with my software. You already see this CoStar. It's not an easy to get software. It's very expensive. So I can help you find and analyze everything. So thank you for watching the full video, and I see you on the next one. Bye.